I am going to tell you about a conversation I had with a doctor that completely changed how I think about healthcare investing. It was about 2 years ago. I was having dinner with a friend who runs one of the largest hospital systems in the country, and somewhere between the appetizer and the main course, he said something that stopped me cold. He said, "Bill, you have no idea what is coming. The healthcare system as we know it is about to be completely transformed. The companies that figure this out will become some of the most valuable businesses in the world, and the ones that do not will be wiped out." Now, when someone with that level of insight into the healthcare industry makes a statement like that, I pay attention, so I spent the next several months diving deep into healthcare. I talked to doctors, hospital administrators, insurance executives, pharmaceutical researchers, biotech founders. I read hundreds of research reports. I analyzed financial statements until my eyes hurt, and what I discovered was remarkable. Most healthcare stocks are terrible investments. The industry is filled with companies that have no competitive advantage, no pricing power, no ability to generate consistent returns. They are at the mercy of government reimbursement rates, patent expirations, regulatory changes, and technological disruption. But hidden within this sea of mediocrity are a handful of truly exceptional businesses, companies with durable competitive advantages that will not only survive the transformation my friend described, but will actually drive it. Companies that I believe will generate extraordinary returns for patient investors over the next decade. Today, I am going to share 3 healthcare stocks that I would trust with my money. Not because they are hot or trendy, not because they have exciting stories, but because they possess the fundamental characteristics that I look for in any long-term investment, applied to an industry that is about to experience massive change. Before I reveal these 3 stocks, let me explain my framework for healthcare investing, because it is different from how most people approach this sector. Most investors think about healthcare in terms of drug pipelines and clinical trials. They try to predict which experimental therapy will get FDA approval, which disease will be cured next, which small biotech will discover the next blockbuster drug. This is essentially gambling. The odds are terrible. Even experts with PhD degrees in molecular biology struggle to predict clinical trial outcomes. And when you are wrong, you lose everything. That is not how I invest. I do not have any special ability to predict scientific breakthroughs. I do not know which drugs will work and which will fail. And frankly, I do not need to know. Because the best healthcare investments are not about predicting science. They are about identifying businesses with structural advantages that will compound value regardless of individual product outcomes. Let me give you an analogy during the California gold rush. Most of the people who went to California to mine for gold ended up broke. They took enormous risks, faced brutal conditions, and most of them found nothing. But do you know who got rich during the gold rush? The people who sold picks and shovels to the miners, the people who provided the infrastructure that everyone needed, regardless of whether they found gold. The same principle applies to healthcare. I want to own the picks and shovels, not the mines. I want businesses that benefit from the overall growth and transformation of healthcare without being dependent on any single drug, any single clinical trial, any single regulatory decision. With that framework in mind, let me tell you about the first healthcare stock I would trust with my money. The first company operates what I consider to be one of the most essential pieces of infrastructure in the entire healthcare system. Every time a doctor prescribes a medication, every time a pharmacist fills a prescription, every time an insurance company processes a claim, this company is involved. They are invisible to most patients, but they are absolutely critical to how healthcare works in America. I am talking about one of the largest pharmacy benefit managers and healthcare services companies in the world. Their business model is beautifully simple. They sit between drug manufacturers, insurance companies, pharmacies, and patients. They negotiate prices, process claims, manage formularies, and ensure that the right medications get to the right patients at the right prices. Now, I know what you might be thinking. Pharmacy benefit managers have been controversial. There have been congressional hearings. There has been criticism about transparency and pricing practices. Is this really a business I want to own? Here is my answer. The controversy actually highlights how essential these businesses are. If they were not providing real value, they would have been eliminated years ago. The fact that they continue to exist, that they continue to process billions of prescriptions annually, that every major insurance company and employer relies on them, tells you something important about their value proposition. The company I am talking about has been steadily expanding its capabilities. They are not just processing claims anymore. They are providing clinical services, specialty pharmacy, home delivery, healthcare analytics. They are embedding themselves deeper and deeper into the healthcare value chain. And here is what I love about this business from an investment perspective. The revenue is incredibly sticky. Once a large employer or insurance company signs a contract with them, switching is extremely difficult. The integration is too deep. The disruption is too risky. Contracts typically last 3 to 5 years and renewal rates are above 90%. This creates an annuity, like revenue stream that is remarkably predictable. Every year, they wake up knowing that the vast majority of last year's revenue is going to recur. And every year, healthcare spending grows, which means prescription volumes grow, which means their revenue grows. The stock trades at roughly 12 times earnings, 12 times for a business with this level of durability, this level of cash generation, this level of growth potential. I think that is extraordinarily cheap. Yes, there are risks. Government intervention is always a possibility. Competition from new entrants like Amazon is a concern, but when I weigh the risks against the opportunity, when I consider the valuation and the quality of the business, I believe this is one of the most attractive risk-reward opportunities in healthcare. The second healthcare stock I would trust with my money is in a completely different part of the industry. This is a company that benefits from one of the most powerful demographic trends of our lifetime. Every day, 10,000 Americans turn 65 years old. 10,000. That is not going to change for the next 2 decades as the baby boomer generation ages. And as people get older, they consume dramatically more healthcare services. They need more doctor's visits, more surgeries, more medications, more chronic disease management. The company I am talking about has positioned itself as the dominant provider of healthcare services to seniors. They own medical clinics. They employ or affiliate with thousands of primary care physicians. They manage the healthcare of hundreds of thousands of Medicare patients. But here is what makes this business truly special. They do not just provide healthcare. They take financial risk for healthcare outcomes. They get paid a fixed amount per Pascal per year by Medicare, and then they are responsible for all of that patient's healthcare costs. If they can keep the patient healthy, if they can prevent expensive hospitalizations and emergency room visits, they make money. If they cannot, they lose money. This model, called value-based care, completely transforms the incentives in healthcare. In the traditional fee-for-service model, providers make more money by doing more procedures, ordering more tests, keeping patients in the hospital longer. The incentives are perverse. Providers benefit when patients are sick. In value-based care, the incentives are aligned. Providers benefit when patients are healthy. They invest in preventive care, chronic disease management, care coordination. They try to catch problems early before they become expensive. They focus on keeping people out of hospitals rather than filling hospital beds. This company has become extraordinarily good at this model. Their medical costs are significantly lower than the industry average. Their patient outcomes are better. Their Medicare quality scores are among the highest in the country. And as a result, they are growing rapidly and generating substantial profits. The opportunity here is enormous. Medicare Advantage, the program through which private insurers manage Medicare benefits, is growing at double digits annually. More and more seniors are choosing these plans because they offer better benefits and more coordinated care than traditional Medicare. And within Medicare Advantage, value-based care is the future. The government wants it, patients want it, insurance companies want it, everyone except the traditional fee for service providers who benefit from the broken system. This company is at the leading edge of this transformation. They have spent years building the infrastructure, developing the clinical protocols, training the physicians, and refining the operations needed to succeed in value-based care. Replicating what they have built would take any competitor years and billions of dollars. The stock has been volatile because healthcare stocks are always volatile. But when I look at the underlying business, when I consider the demographic tailwinds and the competitive advantages, I see a company that should compound value at 15 to 20% annually for the next decade. The third healthcare stock is perhaps the most controversial of my selections. It is a large pharmaceutical company that most investors have written off as a declining business facing patent cliffs and generic competition. They are wrong. Let me tell you why I see this differently than the consensus view. Yes, this company has faced patent expirations on some of its blockbuster drugs. Yes, generic competition has eroded revenue from legacy products. Yes, the headline growth numbers have been uninspiring for several years. But here's what most investors miss. Underneath the declining legacy business is a transformed company with one of the strongest pipelines in the pharmaceutical industry. They have made strategic acquisitions. They have invested heavily in research and development. They have focused their efforts on therapeutic areas with massive unmet need and limited competition. Over the next 5 years, this company has over 20 drugs in late-stage clinical trials, not speculative early-stage programs, but drugs that are in phase 3 trials with significant data supporting their efficacy. Based on my analysis, at least 8 to 10 of these drugs have blockbuster potential, meaning they could each generate over $1 billion in annual revenue. The market is completely ignoring this pipeline. They are valuing the company based on the declining legacy business and assuming the pipeline is worth nothing. But when these drugs start getting approved, when the revenue growth inflects from negative to positive, when investors realize this is actually a growth company disguised as a value trap, the re-rating will be dramatic. I have seen this movie before. I have invested in pharmaceutical companies that were written off as X-growth and watched them transform into high-growth businesses as new products launched. The returns can be extraordinary because you are starting from such a low valuation base. The stock currently trades at 8 times earnings. 8 times for a company with billions in free cash flow, a 5% dividend yield, and a pipeline that could transform the growth trajectory. The downside is limited because the valuation already reflects maximum pessimism. The upside is substantial if even a portion of the pipeline succeeds. And here is another thing that most investors overlook. Pharmaceutical companies are incredible cash generators. Even when revenue is flat or declining, they throw off enormous amounts of free cash flow. This company generates over $15 billion in free cash flow annually. They are using that cash to pay dividends, buy back stock, reduce debt, and invest in the pipeline at current prices. You are essentially getting the pipeline for free. You are paying for the existing business at a reasonable valuation and getting all the upside from new product launches as a bonus. That is exactly the kind of asymmetric opportunity I look for. Now let me pull these 3 stocks together and explain why I think they represent an optimal approach to healthcare investing. The first stock, the Pharmacy Benefit Manager, gives me exposure to the infrastructure of healthcare. No matter what happens with drug prices, no matter which therapies succeed or fail, prescriptions need to be processed, benefits need to be managed, and costs need to be controlled. This business will be essential regardless of how healthcare evolves. The second stock, the Value-Based Care Company, gives me exposure to the transformation of healthcare delivery. The shift from fee-for-service to value-based care is one of the most important trends in the industry. This company is leading that transformation and will benefit enormously as it accelerates. The third stock, the Pharmaceutical Company, gives me exposure to medical innovation at a deeply discounted price. The pipeline represents years of research and development investment. If even a fraction of it succeeds, the returns will be substantial. Together, these three stocks provide diversified exposure to different parts of the healthcare ecosystem while maintaining focus on businesses with durable competitive advantages and attractive valuations. Let me talk about what could go wrong, because I always think carefully about risks before making any investment. For the pharmacy benefit manager, the biggest risk is regulatory intervention. If Congress decides to fundamentally restructure how pharmacy benefits are managed, if they ban certain business practices or cap profits, the business could be significantly impaired. I monitor this risk carefully, but so far I have not seen any legislation that would fundamentally threaten the business model. For the value-based care company, the risks are execution and medical costs. Managing the health of seniors is complex. Medical costs can spike unexpectedly if patients get sicker than projected, or if there is a severe flu season or pandemic. The company has managed these risks well historically, but they are inherent to the business model. For the pharmaceutical company, the obvious risk is pipeline failure. Drug development is uncertain. Even drugs that look promising in phase 2 trials can fail in phase 3. If multiple pipeline drugs disappoint, the investment thesis could take much longer to play out. I have tried to mitigate this risk by focusing on a company with a diversified pipeline, so failure of any single drug does not destroy the thesis. I want to share some broader thoughts about healthcare investing that I think are important for understanding these selections. Healthcare is one of the largest and most complex industries in the world. In the United States alone, healthcare spending is approaching $5 trillion annually. That is nearly 20% of the entire economy. The industry employs millions of people and touches every American's life. Within this massive industry, there are enormous variations in business quality. Some healthcare businesses are wonderful. They have pricing power, recurring revenue, high returns on capital, and long runways for growth. Other healthcare businesses are terrible. They are commodity providers with no differentiation, constantly fighting over price, struggling to earn their cost of capital. The key to successful healthcare investing is distinguishing between these two types of businesses. It is not about picking the next breakthrough drug or predicting which therapy will get approved. It is about identifying structural advantages that will persist through multiple product cycles, multiple regulatory environments, multiple competitive battles. The three companies I have described today all possess those structural advantages. The pharmacy benefit manager has scale, relationships, and embedded technology that create enormous switching costs. The value-based care company has clinical capabilities, physician networks, and operational expertise that took years to build. The pharmaceutical company has a diversified pipeline, global commercial infrastructure, and financial resources that enable continued investment in innovation. These advantages do not guarantee success. Nothing in investing is guaranteed, but they dramatically improve the odds. They create resilience that allows these businesses to weather challenges and emerge stronger. I also want to address the question of timing. Healthcare stocks have been out of favor for much of the past few years. Investors have been obsessed with technology, with artificial intelligence, with anything that seems exciting and new. Boring healthcare businesses have been ignored. I think this creates opportunity. When everyone is focused on the same few hot sectors, the rest of the market gets neglected. Valuations compress, expectations become pessimistic, and that is exactly when long-term investors should be paying attention. The fundamentals of healthcare have not changed. People still get sick. They still need medications and medical care. The aging population is still growing. Healthcare spending is still increasing. The underlying drivers of these businesses remain intact even as investor sentiment has turned negative. I cannot tell you when sentiment will shift. Markets are unpredictable in the short term. These stocks could underperform for another year or two before the opportunity is recognized, but I am confident that over a 5 to 10-year horizon, these businesses will generate attractive returns for patient investors. Let me share a story that illustrates why patience is so important in healthcare investing. About 15 years ago, I invested in a healthcare services company that was deeply out of favor. The stock had been declining for years. Analysts had given up on it. Most investors thought the business model was broken. But when I studied the company carefully, I saw something different. Yes, there were challenges. Yes, execution had been poor. But the underlying business had real competitive advantages. The market position was strong, the cash flows were substantial, and new management was making the right decisions to turn things around. I built a large position and waited. For the first 2 years, nothing happened. The stock went sideways while other investments in my portfolio generated exciting returns. My investors questioned whether I knew what I was doing. Then, slowly, things started to change. The turnaround took hold. Earnings began to grow. Investors noticed the stock started to move. Over the next 5 years, it more than tripled from where I had bought it. The lesson is that healthcare investing requires patience. These are not momentum stocks that move quickly. They are steady compounders that reward investors who are willing to wait. If you need instant gratification, if you need to see results every quarter, healthcare investing is probably not for you. But if you can take a long view, if you can tune out short-term noise, if you can focus on business fundamentals rather than stock price movements, healthcare offers some of the most attractive opportunities in the market. The 3 stocks I have described today exemplify this opportunity. They are not glamorous. They will not make headlines. They will not double overnight. But they are businesses with real competitive advantages, trading at attractive valuations with clear paths to value creation over time. That is exactly what I look for in any investment. And that is why I would trust these 3 healthcare stocks with my money. Let me also discuss how I think about position sizing within a healthcare allocation. I would not put equal amounts into all 3 stocks. The sizes would vary based on conviction, risk profile, and how each position fits with the rest of my portfolio. The pharmacy benefit manager would be my largest healthcare position. It has the most predictable cash flows, the lowest risk profile, and the clearest path to continued value creation. I would be comfortable with this as a significant holding. The value-based care company would be my second largest position. The growth potential is enormous, but so is the execution risk I want. Meaningful exposure, but I also want to respect the uncertainty inherent in the business model. The pharmaceutical company would be my smallest position among the 3. The upside is significant if the pipeline succeeds, but there is meaningful risk that it does not. I want exposure to the opportunity, but I do not want to bet too heavily on clinical trial outcomes. Across all 3 positions, I would probably allocate somewhere between 15 and 25% of my total equity portfolio to healthcare. That is enough to make a difference if my thesis is right. But not so much that I would be devastated if something went wrong. I want to conclude with some thoughts about why healthcare matters beyond just investment returns. We are living through one of the most important periods in medical history. The tools available to diagnose, treat, and cure disease are advancing at an unprecedented pace. Genomic medicine is becoming a reality. Cell and gene therapies are curing previously incurable diseases. Artificial intelligence is transforming drug discovery and clinical care. At the same time, the healthcare system faces enormous challenges. Costs are unsustainable. Access is unequal. Quality is inconsistent. Millions of people suffer from diseases that could be prevented or managed better. The companies that solve these problems, that make healthcare more effective, more efficient, and more accessible, will create enormous value, not just financial value for shareholders, but societal value for patients, families, and communities. The 3 stocks I have described today are all working on pieces of this puzzle. The pharmacy benefit manager is working to control costs and improve medication adherence. The value-based care company is working to keep seniors healthy and out of hospitals. The pharmaceutical company is working to discover and develop new treatments for serious diseases. When I invest in these companies, I am not just trying to make money. I am trying to support businesses that are making healthcare better, businesses that are aligned with what the healthcare system needs, businesses that will succeed precisely because they are solving real problems. That alignment between doing good and doing well is what makes healthcare investing so compelling to me. These are not extractive businesses that profit at society's expense. These are constructive businesses that profit by creating value for all stakeholders. That is the kind of business I want to own. That is the kind of business I would trust with my money. And that is why these three healthcare stocks represent some of my highest conviction ideas for the years ahead. The opportunity is clear. The businesses are strong, the valuations are attractive. The only question is whether you have the patience to wait for the value to be realized. I have made my decision. I am invested in all three of these companies, and I look forward to seeing how they perform over the next decade. But before I finish, I want to dive deeper into some specific aspects of each company that I think are worth understanding in more detail. Let me start with the pharmacy benefit manager and explain why I believe the criticism of this industry is largely misguided. Critics argue that pharmacy benefit managers add cost to the system without creating value. They point to the complexity of drug pricing, the rebates that flow between manufacturers and PBMs, the spread that PBMs capture between what they charge health plans and what they pay pharmacies. But here is what the critics miss. Before pharmacy benefit managers existed, drug prices were even less controlled. Every pharmacy charged whatever they wanted. There was no negotiation with manufacturers. There was no formulary management to encourage use of cost-effective medications. The system was chaos. Pharmacy benefit managers brought discipline to this chaos. They aggregated purchasing power across millions of patients. They negotiated discounts that individual pharmacies or employers could never achieve. They created formularies that steered patients toward effective, lower-cost alternatives. They implemented utilization management programs that reduced waste and inappropriate prescribing. Are pharmacy benefit managers perfect? Is there room for more transparency? Absolutely. But the fundamental value proposition is real. These companies reduce the overall cost of prescription drugs compared to what it would be without them. That is why every major employer and insurance company uses them. The company I am invested in has been particularly focused on demonstrating value. They have pioneered pass-through pricing models where they keep none of the rebates and simply charge a transparent fee for services. They have invested heavily in clinical programs that improve outcomes and reduce total healthcare costs. They have built specialty pharmacy capabilities that manage some of the most expensive and complex medications with exceptional outcomes. This focus on value creation, rather than just value extraction, is why I believe this company will continue to thrive, even as the industry faces scrutiny. Companies that add genuine value survive regulatory challenges. Companies that are merely toll collectors get disrupted. Now let me go deeper on the value-based care company and explain the economics that make this business so attractive. In traditional Medicare, the government pays providers on a fee for service basis. Every office visit, every test, every procedure generates a payment. The more services provided, the more revenue generated. There is no incentive to keep patients healthy and no penalty for poor outcomes. In Medicare Advantage with value-based care, the economics are completely different. The insurance company receives a fixed payment from Medicare based on the expected cost of caring for each patient. This payment is adjusted based on the patient's age, health conditions, and other risk factors. Then the insurance company pays the provider a fixed amount, per patient, per month, or shares the savings if costs come in below budget. Under this model, the provider makes more money by keeping patients healthy. Every hospitalization avoided is pure profit. Every emergency room visit prevented drops to the bottom line. Every chronic condition managed effectively reduces future costs. This creates what I call a virtuous cycle. The provider invests in preventive care and care coordination. Patients get better care and stay healthier. Costs go down, profits go up. The provider reinvests in even better care, and the cycle continues. The company I am invested in has mastered this cycle. Their medical cost ratio, which measures how much of each premium dollar goes to medical expenses, is among the lowest in the industry. Their patient satisfaction scores are among the highest. Their quality metrics consistently earn them bonus payments from Medicare. But here is what really excites me. They are still in the early stages of growth. They currently care for several 100,000 patients. The total Medicare Advantage population is over 30 million and growing. The addressable market is enormous, and they have barely scratched the surface. And as they scale, their advantages should compound. More patients mean more data to improve clinical protocols. More physicians mean more best practices to share across the network. More markets mean more leverage with hospitals, specialists, and other providers. I believe this company could grow earnings at 20% or more annually for the next decade. That kind of growth, combined with the current reasonable valuation, could generate returns that dramatically outperform the broader market. Now let me spend more time on the pharmaceutical company and explain why I believe the pipeline is so undervalued. Drug development is a numbers game. Most experimental drugs fail. Even drugs that show promise in early trials often disappoint in larger, more rigorous studies. The overall success rate from first in human trials to FDA approval is only about 10%. But the success rates vary dramatically by phase of development. Once a drug reaches phase 3 trials, the final stage before FDA approval, the success rate improves to about 60%. And for certain therapeutic areas, for certain types of drugs, the success rates are even higher. The company I'm invested in has over 20 drugs in phase 3 trials. If we apply historical success rates, that suggests roughly 12 to 14 of these drugs will eventually reach the market of those. My analysis suggests 8 to 10 have blockbuster potential. Now, I cannot tell you which specific drugs will succeed. Drug development is inherently uncertain, but I can tell you that the odds strongly favor meaningful pipeline success. This is not a single lottery ticket. This is a portfolio of shots on goal, and statistically, several of them are likely to score. Let me also address the concern about patent cliffs, because this is what has scared most investors away from the stock. Yes, the company has faced patent expirations on some major drugs. Yes, revenue from those drugs has declined significantly as generic competition has entered the market. But here is what most investors fail to appreciate. The company has been planning for this for years. They knew the patents were expiring. They knew generic competition was coming, and they responded by dramatically increasing investment in the pipeline, by making strategic acquisitions to add new growth platforms, by focusing on therapeutic areas with longer patent life and less generic competition. The result is that the legacy business, while still declining, is becoming a smaller and smaller portion of the total company. Meanwhile, the new growth platforms are becoming a larger portion. At some point in the next 2 to 3 years, the growth from new products will exceed the decline from legacy products, and total company revenue will begin growing again. When that inflection happens, investor perception will shift dramatically. Instead of seeing a declining pharmaceutical company, they will see a growing one. Instead of applying a low multiple for a business in decline, they will apply a higher multiple for a business with momentum. The re-rating could be substantial. I want to also discuss the broader context for pharmaceutical investing, because I think it helps explain why this opportunity exists. Pharmaceutical stocks have been deeply unpopular for several years. Politicians from both parties have attacked the industry for high drug prices. There have been threats of price controls, Medicare negotiation, importation from Canada. Every election cycle brings new proposals to crack down on pharma. This political risk is real, and I do not dismiss it. But I think investors have overreacted. The reality is that meaningful drug pricing reform is extremely difficult to pass. The pharmaceutical industry has enormous lobbying power. Any legislation has to balance lower prices against reduced investment in innovation. And most Americans, while they complain about drug prices, also want access to new treatments and cures. We have been hearing about imminent drug pricing reform for decades. Some modest measures have passed, but nothing that fundamentally changes the economics of the industry. I expect this pattern to continue. There will be noise, there will be threats, there will be modest reforms around the edges. But the core business model will survive. Meanwhile, the demographic trends driving pharmaceutical demand are overwhelming. The global population is aging. Chronic diseases are becoming more prevalent. Emerging markets are becoming wealthier and demanding better healthcare. These trends will drive pharmaceutical revenue growth for decades, regardless of political noise. Let me now discuss how these three stocks work together as a healthcare portfolio. One of the principles I always follow is to avoid concentration in any single risk factor. I want diversification not just across companies, but across business models, across value chain positions, across sources of competitive advantage. The three stocks I have described provide exactly this kind of diversification. The pharmacy benefit manager primarily benefits from prescription volume growth. More prescriptions filled means more transactions processed means more revenue. The risk is regulatory intervention that changes the business model, the value. Based care company primarily benefits from Medicare Advantage enrollment growth and clinical excellence. More members enrolled and better outcomes achieved means more revenue and profit. The risk is medical cost inflation that exceeds expectations. The pharmaceutical company primarily benefits from pipeline success and new product launches. More drugs approved and more prescriptions written means more revenue. The risk is clinical trial failures that disappoint. These risks are largely independent of each other. A regulatory crackdown on pharmacy benefit managers would not affect the pharmaceutical pipeline. A spike in medical costs at the value-based care company would not impact PBM transaction volumes. Clinical trial failures at the pharma company would not change Medicare Advantage enrollment. This independence means that even if one of my three picks disappoints, the other two can still generate attractive returns. The portfolio is more robust than any individual position. I also want to highlight the valuation discipline across all three stocks. None of them require heroic assumptions to justify current prices. The pharmacy benefit manager trades at 12 times earnings for a business growing at high single digits with improving competitive position and excellent cash generation. The value-based care company trades at roughly 18 times earnings for a business growing at 20% with expanding margins and a massive addressable market. The pharmaceutical company trades at 8 times earnings with a 5% dividend yield for a business that is about to inflect from decline to growth. In each case, I am paying a reasonable price for a good business. I am not banking on multiple expansion or hoping for speculative gains. I am simply buying cash flows at attractive valuations and waiting for the value to compound over time. This is how I approach all of my investments. I want to win even if nothing special happens. If the stocks simply trade at current multiples and the businesses execute as expected, I will generate attractive returns. If multiples expand or businesses exceed expectations, the returns could be exceptional. Let me share one more thought about healthcare investing that I think is important. The healthcare industry is incredibly complex. There are hospitals, physician practices, insurance companies, pharmacy benefit managers, pharmaceutical companies, medical device companies, biotech companies, healthcare companies, and countless other subcategories. Each has different economics, different competitive dynamics, different regulatory considerations. Most investors try to understand all of this complexity. They build elaborate models of the healthcare ecosystem. They try to predict how changes in one part of the system will affect other parts. They get lost in the details. I take a different approach. I focus on the few healthcare businesses that have characteristics I can understand and evaluate. Businesses with clear competitive advantages, predictable cash flows, and reasonable valuations. I ignore the rest. This means I miss some opportunities. There are probably great investments in corners of healthcare that I do not understand well enough to evaluate. But that is okay. I do not need to invest in everything. I just need to invest well in the things I do understand. The three stocks I have described today all fall within my circle of competence. I understand what they do, why they are valuable, and how they will generate returns. That understanding gives me the confidence to hold through volatility and the patience to wait for value to be realized. The opportunity in healthcare is real. The businesses are strong. The valuations are attractive. These three stocks represent my highest conviction ideas in the sector. I am invested in all of them, and I believe patient shareholders will be rewarded handsomely over the years ahead.